Imagine waking up tomorrow and realizing your salary didn't change. Your job didn't change. Your effort didn't change. Yet everything around you suddenly costs more. You didn't fail. You didn't make a mistake. You didn't waste money. Your currency quietly lost power while you slept. Now, imagine crossing a border and watching that same money either multiply or collapse in value just because you stepped onto different soil. Same paper, same numbers, completely different reality. This is the illusion most people never question. We're taught that money is neutral, that it's just a tool, a fair measuring stick. But if money were neutral, 1 unit would equal 1 unit everywhere. $1 would equal 1 euro. 1 euro would equal 1 yen. But they don't. And the difference isn't random. It's not accidental. It's designed. Ask yourself something uncomfortable. If money is just math, why does where you're born decide how powerful your money will ever be? Why do some currencies travel the world, like royalty, while others are barely tolerated outside their borders? Most people accept exchange rates the way they accept gravity. They don't question it. They adapt to it. But exchange rates aren't laws of nature. They're signals. They're judgments. They're collective opinions about trust, power, discipline, and control. Every currency is a reputation, not a number. And reputations can rise, decay, or collapse. The dangerous part is this: you live inside this system whether you understand it or not. Your savings, your salary, your future plans are all bets placed on your currency's credibility. You might work harder every year and still get poorer if that credibility erodes. So before we talk about inflation, interest rates, or trade, you need to understand one thing clearly. Money doesn't start equal. It never has. And the gap between currencies tells a story about power that most people are never taught to see. Here's a thought experiment. Would you rather hold 1 unit of a currency that buys a house, or 1,000 units of a currency that buys a loaf of bread? Instinctively, you choose purchasing power, not face value. Yet people constantly confuse the two. They look at big numbers and assume importance. They see small numbers and assume weakness. But currency values are not rankings. They are ratios. A currency with huge denominations is often advertising failure, not strength. Hyperinflation forces numbers to grow while value disappears. So when you see exchange rates, you're not seeing worth. You're seeing comparison. One currency measured against another. That's critical, because it means no currency exists alone. Every currency lives inside a hierarchy. Some sit at the top, trusted globally. Others orbit them, dependent and vulnerable. Ask yourself this: if your currency suddenly disappeared tomorrow, would anyone outside your country miss it? Or would global trade continue without noticing? That answer tells you more than any exchange rate chart ever could. Strong currencies aren't strong because they look impressive. They're strong because people want to hold them when things go wrong. During crises, capital doesn't hide. It runs. And it runs toward currencies with reputations for safety, discipline, and predictability. Weak currencies aren't weak because their people are lazy or incapable. They're weak because trust has been damaged, sometimes repeatedly. And trust, once broken, is incredibly expensive to rebuild. This is why currencies with similar economies can have wildly different values. It's not just production, it's belief, it's history, it's memory. Money remembers what governments try to forget. Every broken promise leaves a scar. And markets don't forgive easily. They don't care about intentions, they care about outcomes. So the next time you see a currency trading low, don't ask how many zeros it has. Ask how many times trust was violated to get there. Strip away the paper, the coins, the digital screens, and money reduces to a promise. A promise that tomorrow, someone else will accept it from you. That's all. Gold once acted as a shortcut for trust because it was scarce and hard to fake. But even gold didn't guarantee fairness. Empires controlled gold flows. Colonies supplied it. Power decided access. When nations moved away from gold, they didn't abandon trust. They centralized it. Fiat money isn't fake because it lacks gold. It's fragile because it relies entirely on credibility. Governments promise not to abuse the ability to create money. Central banks promise discipline. Markets watch carefully. Ask yourself, what happens when that promise is tested? Wars, recessions, political pressure, elections. Every crisis tempts leaders to print, and every time they do, the currency's reputation takes a hit. Sometimes small, sometimes fatal. Inflation isn't just rising prices. It's a signal that trust is leaking. People stop saving in that currency. They rush to assets, foreign money, anything stable. Once that behavior starts, it feeds itself. This is why inflation accelerates instead of stabilizing on its own. Confidence doesn't decline smoothly. It breaks suddenly. Think about your own behavior. If you knew your money would lose value next year, would you hold it, or would you spend it as fast as possible? Now, multiply that instinct across millions of people. That's how currencies collapse. Not through ignorance, but through rational self-preservation. Strong currencies survive because people believe restraint will hold under pressure. Weak currencies die because people expect abuse before it even happens. Trust isn't declared. It's earned slowly and destroyed quickly. And once gone, no policy announcement can bring it back overnight. Imagine a tax that no one votes on, no one debates, and no one can avoid. A tax that quietly reduces your purchasing power year after year while your paycheck pretends nothing happened. That tax is inflation. Governments rarely call it that. They frame it as growth, stimulus, adjustment. But for you, the effect is simple. Your past labor becomes worth less. Inflation punishes savers and rewards debtors. It transfers wealth from the cautious to the leveraged. Ask yourself, who benefits most when money loses value? Is it the worker paid in fixed wages, or the institution that owes massive debts denominated in that same currency? This is why inflation is politically tempting. It feels painless at first. No riots, no immediate backlash, just slow erosion. But markets aren't fooled. Foreign investors price inflation instantly. Higher inflation means higher risk. Higher risk demands higher returns. If returns don't compensate, capital leaves. And when capital leaves, currencies weaken further. This creates a loop that's incredibly hard to stop. Countries with histories of inflation are punished long after the policy ends. Reputation lingers. This is why two nations with similar inflation today can have very different currency strength. One is trusted to stop, the other isn't. Ask yourself another uncomfortable question. If inflation is temporary, why does it keep returning? Because discipline is easy in calm times and politically impossible during crises. Every government believes it will be the exception. None are. Inflation isn't a glitch. It's a feature of systems that allow money creation without immediate consequence. And the cost is paid not by policymakers, but by people who hold the currency and trust it to protect their effort across time. Money moves toward reward adjusted for risk. That's not ideology. That's physics. Interest rates are the gravity wells of the financial world. Higher rates pull capital and lower rates let it drift away. When a country raises interest rates, it's offering foreigners a better deal for holding its currency. More demand strengthens the exchange rate. But here's the trade-off most people miss. High interest rates also raise the cost of borrowing domestically. Businesses slow, consumers hesitate, growth suffers. So central banks are always trapped between defending the currency and protecting the economy. Ask yourself, when rates rise, who complains first? Borrowers. When rates fall, who quietly suffers? Savers. There is no neutral setting. Every decision creates winners and losers. Strong currencies often come with slower growth and tighter conditions. Weaker currencies often accompany faster growth and riskier expansion. This is why some countries tolerate weaker currencies deliberately. They accept depreciation to fuel exports and employment. Others prioritize stability at the cost of speed. Neither path is free. Investors constantly judge whether a country's interest rate compensates for its political and economic risks. If it doesn't, money leaves. And money doesn't need permission to leave. It just goes. This is why interest rate announcements move currencies instantly. Not because traders are emotional, but because expectations shift. Ask yourself, if your country suddenly cut rates aggressively, would that signal confidence or desperation? Markets decide in seconds, and their judgment becomes your exchange rate, whether you agree with it or not. Thanks for watching. If this made you think differently about the money in your pocket, Be sure to subscribe for more. See you next time.